speaker share today is not really a buy or sell advice, okay? We are just doing a knowledge sharing purpose. So whatever that you want to do, please advise your advisor or understand the risks involved, okay? Now, about our company, Phillip Futures, we are incorporated in October 1995, and we are a wholly owned subsidiaries of Phillip Capital Holdings. And our mother company is in Singapore, but our HQ in Malaysia is based in Kuala Lumpur, somewhere near the KLCC. Okay. Now, we are a trading and also a clearing participants of Bursa Malaysia Derivative Berhad, okay, and also we hold a CMSL license. So meaning to say we are a legal broker house in Malaysia to operate in Malaysia, and we are regulated by the Security Commission. So it is absolutely completely safe for investors to trade through our company. Now, our company, we are the first broker house in Malaysia that actually introduced an online trading platforms for our investors to trade both local and foreign products in under one single platform, okay? So it doesn't need to log in 2 different platforms in order to trade different products, okay? This provides a very great convenience to if you are looking at both different products, which is also why we are the top choice for lots of professional investors in Malaysia. And also, I want to take this opportunity to actually extend our gratitude to all our clients. Without you, we won't be able to achieve this. So in 2019, we got 3 big awards from Bursa Malaysia, being the main one as we are the champion of the institutional derivative as a derivative trading participant. We have offices in over 14 different countries. With that, we don't only offer products just in Malaysia. We offer products across all different exchange, including Singapore Exchange, US Exchange, Hong Kong Exchange, Japan Exchange, etc., etc. So basically, what you want to trade, you might be able to find something that is suitable for you because of the product range that we covered. Now, let me move on to what we do. So our main focus, just like our company name, Phillip Futures, our focus is always in futures trading. Okay, so futures trading basically can be categorized into different categories like interest rate, index, energy, agriculture, or metal futures. And tonight we are talking about crude palm oil. So crude palm oil actually falls under the agriculture futures. Okay, other than futures, we have launched a very new product. Okay, it's called the contract for difference, where we give our investors, we allow our investors to trade Bursa top 100 shares with a leverage. Okay, so this is a really good product for investors that want to participate in Bursa Malaysia, but with very small amount of margin. Okay, it's a really great product, and we are the first broker house in Malaysia to actually introduce these particular products. So if you want to know more about the contract for difference on Bursa Malaysia top 100 stocks, feel free to talk to us, okay? Because the margin for you to trade the blue chips is only 10% over the share price, and for the mid-cap company, which are the stocks that falls under the FM70 index, the margin required is only 20%, okay? So really great margin with good trading opportunities. Okay, now why trade with our company? First of all, we offer 24-hour support for our clients who trade foreign products. So basically, no matter what time during the day you need help, just call in our dealing line. Someone will definitely be there to help you. Second, we offer the latest market news exclusively to our clients on a daily basis. Third, we offer free advisory advice. So if you are interested to trade something, but you do not know where to start, talk to us. We can help you to find something that is suitable for you. And lastly, like I mentioned earlier, we offer products from all across the exchange in different countries. So definitely there is something that is suitable for you. Okay, now, just to let all of you know that, like I mentioned, we do offer one-to-one coaching section for free, okay? So if you want to know more about technical analysis, you want to know more about the products we offer, you want to know more about how our platform works, you want to look at it, talk to us, we are more than happy to actually sit down one-to-one to go through it with you. Don't worry if you are a beginner, okay? Second, we offer free seminars and webinars on a monthly basis. So right now we can't do seminars, but we do organize webinars, a few webinars in a month. So feel free to check it on our website. We always upload the registration link on our website at Phillip Futures. Okay. Lastly, account opening is actually free of charge. Okay, you don't need to pay anything, zero charges. But we require to fund in to actually activate your account. Now, just to let all of you know that we at Phillip Futures, we try to always be the first. So this year we have launched our first online trading account opening. Okay, so you can open a futures account at the comfort of your own house. Okay, it doesn't need to come to our office. You can open it at home. Okay. Later on, I will put a registration link for you to scan, but just to let all of you know that we do have this online account opening right now, okay? Now, just to quickly show you our platform. So the platform that our company is using is called the Phillip Nova. It's absolutely free of charge. So we don't charge you anything, even if you don't trade a single lot amount, which is a really great advantage for beginners because there is no cost for you to actually open an account and to learn how to trade. Okay. Second is our Phillip Nova is run on web-based, so it doesn't need to install anything in your PC or on your phone to run it. It's web-based. Just go to Google and you are able to log in. Okay. Third, we offer live chat in our platform. So really, there is no reason that you won't be able to trade because live chat is available on mobile, it's available on your desktop, and we have it basically for quite a fair bit, even on foreign products. Even on US market, we do give you live chat for free for you to use, okay? And also, on our live chat, you can actually do buy and sell directly by looking at the chart, okay? It's great convenient, and you can trade both local and foreign products under this one single platform. Really easy to use, user-friendly, okay? And also just for all of your information, we have a application. So this application, if you download it on your mobile, it's not for you to trade, but we will inform you that your orders has been filled or has been matched. Okay, we will let you know. So it's like a pop-up notification, and also we will give you market news throughout the day. Okay, so it's a great combination. So for those that are interested to try out or to have a look at how our demo, Phillip Nova demo account looks like, I will give you guys 30 seconds to actually scan this QR code. Okay, I give you 30 seconds. You scan this QR code, and you can try to register a demo account. Okay, you get a demo account, have a look at how our Phillip Nova demo looks like, and if you want to know more, talk to us, and we will show you more about it. Okay, I'll just give you another 10 seconds to probably scan it if you want to. Okay, just yeah. And yeah, we even have market depths, allows you to look at different buy and sell queue. Okay, yeah, and all sort of order types to cater your needs. Now, okay, so that is all for our company. Now I will try to pass it to our speaker of the night, Marcello. So yeah, to talk more about palm oil. So Marcello is our Phillip Futures institutional sales manager, and he managed international and local corporate clients and did a lot of research in palm oil. Okay, so Marcello, I will pass the rest of the time to you. Hello.
Hello, hi, good evening, Jocelyn. Can you hear me?
Yeah. Yes, I can hear you.
Okay, thank you, William, for the introduction. Very thorough as usual. Thanks for that, and thanks for all the attendees for participating this evening, and really good numbers as well to this webinar. I'll try to discuss and in that view on the crude palm oil market, and we'll then finalize with the market outlook in terms of what is perceived as a realistic price range. Now, I won't run through the disclaimer for obvious reasons, but going into the introduction. So again, the purpose for this webinar is to discuss the current view on the crude palm oil market, and this with focus to 4 key reference points. So the price imbalance for crude palm oil versus the fundamental analysis, we'll go through that quite widely. The price correlation of crude palm oil to edible oils, that is something that most of you do trade on a daily basis versus the Dalian, RBD, and bean oil contracts, as well as the cross-market spreads and the relevant price correlation versus bean oil at a CBOT. We'll look as well at the key factors for crude palm oil prices currently on a rally, and the opportunities for its reversal, or where we see this as more realistically priced. And then, of course, we'll finalize with the price outlook versus the forward-month expectations. Hope as well those that have any inquiries at the end of the presentation to please voice them. I'll try and be as concise as possible and reply in the best possible way as well. So starting with the CPO price imbalances versus its fundamentals. So we have seen the price rally fueled by lower palm oil supply and its expectation since May, with lower palm production in August by 24% year-on-year locally, and by 17.8% year-on-year in Indonesia. This leading CPO price is 52% higher to today's levels, closing at 30.40 in the cash spot market. Now, the soybean oil and sunflower oil demand, as well as its lower output, sustained the cash prices and its correlation to the CPO futures to $733.50 or 30.40 ringgit. CPO futures in a controlled price consolidation were sustained in a range of 2750 to 2900. This based on a higher daily volume seen more recently over the past month in particular, with 24 to 25,000 lots as a base, with an open interest increasing from 185,000 lots to 200,000 lots a couple of sessions ago. Now, the main question that obviously everyone is asking, in particular those that are trading and researching this market, is whether we actually are at a balance versus fundamentals, or whether there is a little bit too much of a speculative trading that is fueling the price progression and potentially prices moving into a bubble. So looking at supply, palm oil being very much a supply-driven market, whether there is or there isn't a very strong demand, as we've seen in June and July versus more recently. If we look at, say, the trends that are plotted into this chart versus in terms of price trends versus Malaysian and Indonesian production and inventories, what we see is the prices very much in line with supply levels. If we look at Malaysian supply levels versus Indonesian supply levels, supply is currently inventories, production, taking production as a reference, it's currently in the region of 1.7 million metric tons versus 224 million metric tons a year ago. Indonesia is around 3.7, 3.9 million metric tons versus 4.5, 475 million metric tons a year ago, and therefore we see 17.5 to 24% lower production at Malindo, with prices realistically sustained at $733.5 versus, say, $550 a year ago in September, when prices at BMD were at 21 to 2200 ringgit at a range. So if we look at supply and where we are currently, this is supply as plotted for the August period. There is realistically an expectation that prices are sustained at a balance, and therefore, though we have seen very strong participation from trading houses and the funds as more speculative, we have seen as well some very strong hedging, in particular from refiners, and as well some producers layering their hedgings over the past couple of months, realistically, not only for the third and the fourth quarter, but as well for the first quarter of 2021. Now, from a price sustainability, it seems like, based on this view, the decrease of 20 to 25% year-on-year production at Malindo, this leads to a 50% increase at BMD prices, and that seems practically fair to some degree. Now, looking instead at the future price correlation, this has been discussed quite widely over the past couple of months, in particular, between CPO versus soybean oil, sunflower oil in particular. So the CPO active month contract over the July, August, and mid-September period traded 650 ringgit or $157 per metric ton higher on lower USDA supply revisions for the grains and the oil seeds versus the lower Southeast Asian palm oil inventories. So this mainly on steady consumption, restocking, and demand activities from the March-April 2020 historical lows leading into May the 10th lows. Between July and mid-September, BMD moved up 32% as part of that 52% price increase, and this by $177.2 higher from $22.75 to $3,002. This in a range of $547 to $724.2. This was very close and in line with the CBOT bean oil prices trading at a higher range of $164.3, between $27.74 and $35.19 a pound, or in dollars per metric tons at 611.5 to 0.5 to $775.8. Dalian RBD futures, keeping it simple and looking at this opposed to focusing as well on the soybean oil and soybeans number one contract, moved up $43 above its price correlation from 4,830 to 6,232 yuan, or $207.2. The two obvious conclusions are, for a higher consolidation taking place in the veg oil complex on the Chinese and Indian-led demand. We've seen this very sustained recently, both in China and in India, on restocking, and this leading to some perspective whether perhaps prices might be overinflated given the regression and spread analysis of the past year. and historicals showing a weakening effect on the large positive linear association with an R-square of 0.8 between CPO and soybean oil and RBD. This versus a more recent and lower positive linear association, 0.3, 0.4, seen over the past month in particular, and this pointing to a likelihood of lower spot demand moving forward. Demand has been an interesting topic over the past nearly 3 weeks, because at the beginning of the month, the lower positive linear association, or the lower correlation, put in simpler terms, pointed to a demand potentially deflating to as low as 2 to 5%. We're now looking realistically for September at least 8 to 10% increase on a monthly basis. Nevertheless, some point that the weakening of the linear association or correlation is in function of CPO, soybean oil, and CPO and RBD spreads, which are deviating from historical patterns. This due to the current uptrend progression, which is quite aggressive. This is likely to impact palm oil demand in the fourth quarter as well as in the first quarter 2020. And the first quarter, 2021. The first quarter 2020 was a prime example of a such pattern, and we'll go into this in a minute. So looking at price correlations versus spreads versus the perceived demand, if we look at the period where prices went to historical lows, and we're obviously looking at March, April, May, one thing that comes fairly clear is the stronger demand opportunity that was perceived not only as spot demand, but as well demand for the second half and first quarter 2021 led to a stronger correlation in prices moving forward, and this between June and July, realistically, and mainly in July, where we had the strongest demand for some time on the CPO side. But from thereafter, we have noticed not only a narrowing spread, as an example for CPO and soybean oil, which is currently quite aggressive and moving into the lower 40s and 30 ranges. But we have seen as well, instead on the Chinese market, a widening of the CPO RBD, still putting that in context versus demand from $184 to $125 in May. And this showing that at least at Chinese market, the viability of maintaining strong import margins moving into the fourth quarter and the first quarter of 2021 will be more challenging given current prices. And as well, the correlation, as you can see, not sure if you can see the cursor, apologies. If you can see the cursor, the correlation in prices between CPO, soybean oil, and the Dalian RBD is slowly narrowing. So moving into what seems to be perceived as prices potentially moving into a bubble, let's focus first on what is clear and what is currently known and priced in as tightness at the market and it's concerned. So since June, these have been persistent with reference to Lorix and RBD all-in prices, which have driven prices up from May 4th till September the 14th. This presentation was done mainly yesterday, so Apologies if you will find some mismatching prices. Most of them actually should be on the spot, but anyway. The higher hedging for the CPO benchmark contract was led to a 52% bull run reaching 3,002. Something interesting is if we look at the key supporting factors, as we know, lower labor at fuels, delayed peak beyond the June mini peak as production. The demand for bean oil, which price correlation were more recently in line with the Dalian as well, with the Explorer at the seaboard side, which held the pound discount to $60–65. That is very much narrowed to early 40s now, as well as the COVID impact to East Malaysian and Indonesian output back in July, when production was 4% lower, 1.8 million metric tons, and 10.6% lower at the Indonesian side, 3.45 million metric tons. As seen earlier in the fourth slide, this leading to a production falling 24% year-on-year locally, and in Indonesia by almost 18%. So looking at prices at BMD as well as cash prices, locally ending stocks do show some backing, given the projection for September is still for ending stocks to be 14.8% lower versus August, month on month. Although we see production coming up 7.85%, we see exports as well realistically priced 9.4% higher, with a local domestic consumption which is just 2% higher, and imports still very much lower, considering interestingly enough, Indonesian prices are still very much supported, with premiums now moving into $10 to $14, which seems in a way one of the reasons why we have seen some very strong short selling and layering for prices moving between 29 and 3,000, because if we look at the Indonesian supply and demand expectations, as I see them at least, production over there is on an uptrend now and has been since August, with ending stocks moving from sorry, apologies, just a second. Ending stocks moving from 18.2% higher in August to now 39% realistically higher in September. I believe this will most likely at some point put pressure both on cash market prices, spot prices in particular, and nearby, as well as at BMD, because current levels, if production really does peak up over the next month, we will most likely see a very strong pressure at BMD. So moving into the key factors for rally and reversals. So RBD oiling and steering, as we saw today by the close, around $775, if not mistaken, but above $775 to $800 range, those supported by front-month spreads. These very likely will invalidate the competitiveness to edible oils, not only at European but Indian ports. This at a moment where Europe is starting to buy less, as seasonally is the case, while Indian ports are instead looking to step up for the seasonal festival demand. And we have read more recently perspective from some commodity houses looking at potentially as much as 600,000 metric tons, which was the 600 to 800,000 metric tons, which was previously the CPO demand prior to the restriction on the licensing as mandated by the Indian government back in October, November last year. Current price levels will be a concern mainly for Indian buyers, because at the moment they are switching over from sunflower oil to CPO and soybean oil, which are better priced at stronger discounts. So a higher consolidation in the cash market side might potentially invalidate demand. From a biodiesel demand perspective instead, we've seen this recently lagging over the past month, perhaps even over the past couple of months, with palm premium currently at $404 as seen today versus 161 over the past year, where biodiesel realistically is better price versus palm is better price versus biodiesel demand at a POGO spread, which is $75 to $100 discount. We clearly way past that. So this is suggesting the likelihood of a reversal in prices, given the soybean oil all-in spread as well as seen flattening now to $28 premium from $28 premium in July. And the soybean oil premium versus palm oil was reaching today $46 a ton versus an average of $65 in the past year. Looking at Indonesian CPO spot price, this was today at $757.5, nearing $68.5 above the August high price at $689, as production there is likely going to increase by nearly 20% in August, with now a narrowing of $1.5 premiums versus the local palm. If we look instead, and this is very interesting, if we look instead at the spreads between BMD and the Apex, we see instead BMD now moving into a stronger discount. This as well versus spot CPO prices. And I think this discount, as this reaches say $14, $15 and above, this will put some pressure at BMD inevitably, because the Indonesians will find, given better supply at their end, an interesting hedging opportunity, in particular from the producing side, as refiners have for the past realistically 2-3 months hedged their requirements in the forward months. So therefore, we expect some supply concerns to ease and balance versus CPO spreads and flat prices. For those that have traded the spreads over the past couple of weeks, and in particular today, you have seen these easing very aggressively. In particular, the November-December spreads were a little bit of an eye-opener today. And this, given local delivery south reached 30-40 ringgit, or $733.4, as RBD all-in and steering went in line at $777.5. So this is a bit more of a brainiac charting, but if we look with focus to the Chinese demand versus the pricing of the soybean production levels versus as well the price correlation to CPO at BMD and Apex, what we are seeing at the moment is, again, the $750 to $800 as a very strong resistance level. And this is something that we have previously seen not too long ago, over the past year, between the fourth quarter and in particular since January 2020, as mentioned earlier, as prices then reached $794. And with the implosion of demand moving to 1.3 million metric tons locally, which was then 200,000 metric tons lower versus December, and the inherent implosion of prices at BMD, as well as at the Dalian, as well as at the APEX side, to reaching lows of $450 to $473 back on the 10th of May, and obviously then moving into an uptrend. It's quite interesting, the flattening of the spread between the third month at the APEX as well as at the BMD. I refer often to the APEX with reference to the spread versus the BMD, because it's an eye-opener versus not only supply expectations in Indonesia, but as well the hedging on the East Malaysian side and the Indonesian side versus Bursa Malaysia derivatives and the APEX. Once specific price ranges are seen as very, very appealing versus demand, and of course versus the demand elasticity as prices move into a bubble. Now, finalizing this presentation and looking at the price outlook, so CPO futures should stay supported at 26 to 2700 from periodic retracements or corrections to $625 to $650. This mainly on expectations for 2020 lower year-on-year production locally by 300,000 to 600,000 tons to 19.2 to 19.5 million metric tons, and yet an unclear supply picture for the first quarter 2021, which in my perspective should be fairly ample from a production perspective, given as well the very beneficial weather that we've had this year, and strong rainfalls, and the possibility as well of an earlier monsoon. We have prices which instead should be supported above 2750 to 2850 if production slows both in September and October at Malendo. At the moment, that doesn't seem very much the case, but obviously we are looking at what is the peaking for production in Malaysia, given there is a very strong production uptrend in Indonesia at the moment, and this versus a higher range price at 2950 to 3050. We're not very far actually from the higher side of this range, and reverting most likely and most strongly from 3150 3200. This is where I strongly believe there will be a very strong reversal versus the demand implosion in the forward months. We have to consider as well that what we see and what we perceive as demand in Q3 and Q4 is part of those subscriptions that were placed between May and July, when prices obviously were much lower and seen much more at a balance versus the current price range. As well, we have to look at historical retracement. So 3150, 3200 is where we've seen the strong reversals more recently between January, February 2017 and January 2020. Then when we had the El Nino switching to ENSO neutral, and as well more recently in January 2020 when we had demand falling to 1.2, 1.3 million metric tons from December. If instead we have seasonal peaking harvesting between mid-October and November, which seems very likely the case, then prices should be easing to 2,500 to 2,600. This depending very much on the Indian demand versus competing edible oils, bean oil and sunflower oil, as well on the bean oil and sun oil performance in future terms. So cash prices should hold higher for now, realistically at 29.50, 30.50, with RBD all-in front month at $780 to $800 per metric ton. This is a range we have to look very, very carefully because demand will react at this price range as it did historically over the past 3 to 5 years. And having said this, feel free to get in touch and have an interaction. And I hope you wish to voice any questions. If any, of course.
Yeah. Okay, hang on. Any questions from the floor? Let me have a look. Okay, so Marcello, there is a questions for you from Mr. Lee. He is asking that in the newspaper, we often hear analysts mention that the price range for palm oil is somewhere between 2003 to 2006. Are they referring to spot month or forward contracts month or benchmark month?
No, I'm referring to the benchmark benchmark futures.
Okay, they are referring to benchmark futures. Okay, so there is one more question. So how is the impending lockers in India is going to affect the CPO price?
There has been quite a bit of talk about the locust impacting the Indian crops back in July. To my knowledge, that is something that should have been contained by now, but and for honesty, we need to research that further. I don't really have an exact answer on that at the moment.
Okay. Or probably if you do find the answer, you can let us know, and we can email it to this person who asked the question.
Yeah, that there was sorry, just to add to that, that there was a bit more supportive talk by one of the local banks in a research note that was sent out recently, and this very much towards supporting the current price range. So realistically speaking, we're looking still at 3050 to 3100. But then again, we have to monitor that Indian demand versus sunflower oil and bean oil if CPO becomes less competitive. And considering as well, India does import quite extensively bean oil.
Okay, noted on that. Okay, so the next question is about the palm oil demand in US. Do you think that the demand of palm oil in US and India in the coming months, what is your view on that?
So in US, the palm oil demand is still very much as by historicals in the region of, say, 50 to 100,000 metric tons at most, realistically around 50,000 metric tons. It's not something that I would compare to Indian or Chinese or European or Middle Eastern buyers in terms of requirements. As well, the Americans are now moving into the harvesting for beans, and based on sorry, you guys still there?
Yeah, still listening.
So yeah, I don't think that demand will definitely increase moving forward, as well as US over the next few months will move into a stronger winter period. So I think the demand, looking into seasonal patterns, is more towards India and China at the moment. Not even Europe, or definitely not the US.
Okay. Yeah, okay. That is a good one. Hang on, just let me see if there is any more questions from the floor. Please ask if you do have any questions about CPO. There is one more. What is your opinion that CPO gap up and gap down every day? It's very gappy by a trader.
Well, there is, as mentioned earlier, that there is a strong element of speculative trading at the moment, not only in terms of institutional foreign trading from the funds or from the prop trading sites that trade this market, but as well domestically from the local participants and from the retail component. And those have been a little bit more active as of recently, not to the same level as the institutional investors, but they're slowly coming up. What is perceived as stronger resistance ranges has been shorted, and we've seen a bit of that as well today.
Okay, cool. All right.
But nevertheless, apologies. Nevertheless, just to complete. Nevertheless, we have to, as mentioned, I think it was a couple of weeks ago when we did our webinars, as mentioned over the past couple of weeks, over the 3 webinars that we did with clients and attendees, we have to look not only at support and resistance versus the intraday trading participation and eventually the open interest, but we have to look as well at the volume profile over specific periods versus price ranges in order to understand not only let's say the more speculative trading within these price ranges, but as well what is perceived as fundamentally more viable in a consolidation, from a consolidation view, because clearly we have seen a very strong higher consolidation over the past couple of months in particular.
Okay, cool. Just one last questions. Do you do any research in Indonesia biodiesel demand and the status of the biodiesel fund? It's probably correlated to CPO in biodiesel.
Yes, not me directly. I have some sources, friends and clients that look into that more specifically, and they do provide some insight on that. Again, the Indonesian biodiesel market, sorry, the Indonesian biodiesel requirements are something that are being discussed mainly with focus to the new structure versus the levy. But given current prices, even considering the even considering the CPO fund pumping money into the mandates, current prices are not very much viable to a sustainable mandate in Indonesia, as clearly not in Malaysia, definitely.
Okay. I guess that is all the questions from the floor. So thank you very much, Marcello. Okay.
Absolute pleasure.
Yeah, thank you. So just let me finish to wrap up the whole thing. So for those that wants to open account online, feel free to scan this QR code. Okay, you can do it online at home in front of your PC. It doesn't need to come to our office. Okay. Now,
sorry, William, just the last one, the last one, because I noticed the question that was posted by. Let me just check. Just spare me a second. I will try as well to come back on some of these questions. Actually, quite interesting. There was a bit of an interesting question from Mr. Richard Wong on the current price trend. Put in funny terms, I understand his perspective and where he's coming from. I'm clearly trying to discuss price ranges and their consolidation over the past couple of months, as well as what I perceive as more likely as a reversal, again, as an indication that needs to be evaluated in time, that needs to be screened. What I'm discussing is not cast in stone, and it's something that I would research on a daily basis to make sure that I readjust versus market expectations. And therefore, I'm not stating that it's worth going long now to short 2 months from now. That is not what I'm stating. What I'm stating is we have to look at specific price ranges and how those are perceived as feasible versus demand elasticity, because at some point that will take place, as well as versus the hedging of the Indonesian producers, because they have in the past induced a stronger reversal from, as I mentioned, the 3050s to the 3200s. Having said that, there was on one occasion, if I'm not mistaken, mid 2000s, there was one occasion where the price actually shot up to 4,000 ringgits per metric ton. I don't think we are in that case, but again, we have to readjust perspective in very realistic terms versus supply and demand expectations, as well as the feasibility of prices versus fundamentals and price correlations. And nothing is cast in stone. And by all means, Richard, if you wish to go long and short a week from now, please do so.
Okay, thank you. Okay, so just a very quick on our upcoming one. Okay, so on Monday, I'm not sure whether how many of you here actually, I'm not sure how many of you here actually look at soybean and corn. Do you guys mind to just let me know? Just type 1 if you do monitor soybean and corn, just let us know. Okay, because soybean and corn actually is quite correlated to CPO then, and they have been showing really great trend at the moment. Okay, so if you guys want to know more about soybean and corns, on Monday, next upcoming Mondays, 8 p.m. at night, we'll be sharing a little bit about soybean and corn, and we can explore the opportunities in these two products together. But at the meantime, just let me know by typing 1. Just let me know if you are actually looking at these few products, soybean, corn, or even soy oil. Okay. And also, these are the soybean contracts that is available. If you are interested to trade, okay, we have mini contracts and mini corn. Mini contracts and mini soybean, and the margin are really very affordable. It's only USD 330 for mini soybean, and for mini corn it's only USD 187. Okay, you can participate, and the trading hours is almost 20. Is quite very long. I mean, yeah, even at night that you can trade at home. Okay, so just try to search us on Facebook at Phillip Futures. Okay, then you can try to join us on our Facebook Live on Monday night at 8 p.m. And also, just for all your information, we have a Telegram account as well, Phillip Futures, for us to put all the statistics, and also a YouTube channel where we will upload all the recordings over there as well. So check us out. Okay, so for that, thank you everyone for your time to join us tonight, and have a good night. Thank you. Bye bye.
Thank you. Thank you. Bye.
Thank you, Marcello. Bye bye.